Hello, welcome back to International Finance. So this week, we're going to focus on corporate governance. Our last lesson, we introduced the international monetary system and we took quite a bit of time to understand currency crises. So we've introduced basically international and institutional details into international financial markets. We examined how Forex can be open versus fixed. We looked at different government interventions into Forex markets. So we talked about expansionary, contractionary, monetary, and fiscal policy. And we also investigated the trilemma, the trade-off between a country having fixed rates, open capital flow, or independent monetary policy. We used the case of Greece to understand the trilemma and market efficiency, and then we focused on many different currency crises to understand market efficiency and contagion. This lesson, we're going to focus on corporate governance. So we're going to look at the separation between voting and cash flow rights. We're going to discuss conflicts of interest, information asymmetries, essentially managers know things that investors don't. And then we'll look at how that can give rise to agency concerns. And we'll see how firms can use different solutions to address these challenges and how the solutions can thereby affect firm value. So let's jump right in. We've got our present value equation, and we'll think of corporate governance as affecting firm value in three ways. First, we have our free cash flows. So if free cash flows are being spent on wasteful or negative NPV projects or anything that's distortive, then obviously having better governance is going to increase firm value. The second is through our weighted average cost of capital. If the firm is better governed, all things held equal, it's going to lower the cost of capital because as an investor, I want to be compensated for appropriate risk. A risk that I face is whether or not the firm or the financial managers or someone is not going to pay me back. So if I can mitigate that risk or reduce that risk, all things held equal, I'll be more willing to pay for the risk that I want to be compensated for, like proper, actual, systematic, or business or firm specific risks. And then the third way that we'll think about corporate governance affecting firm value, it's not in our numerator or in our denominator. It's more so general for the overall economy. And that's that corporate governance is going to basically increase market efficiency and economic growth. And many studies show that corruption reduces economic growth. And that should feel intuitive. So let's kind of orient ourselves a bit. We're going to be discussing corporate governance from the perspective of looking at the role of financial managers and also the role of investors. So to understand what we mean with financial managers, let's take a look at a decision tree. We have the financial manager, you have an entrepreneur, you have a great idea. So you go to the market and you raise cash. So step one, you sell securities to investors, and those are going to be your stockholders and your bondholders, your debt holders. You raise cash, you take that cash and invest it into firm operations. Those operations then produce cash, and then you have the choice to either send that cash back to investors in the form of dividend payments or debt repayments, or to reinvest that cash into the firm, and then things go back over in terms of retained earnings as a way of funding operations. So all along this process, there is rampant opportunity for a lack of corporate governance. I know from working on cases that involve each of these processes, all along the way, there are cases where a company or an investor would feel that they basically were violated, like their trust was violated, or like a financial manager or a financial advisor basically did not perform due diligence. So to kind of understand that, let's look at the first step where you raise cash. If I inflate the value of the company, if I basically have some bad information that I keep to myself and it allows the stock price to be too high, if that information came out, people would want to pay less for the company. The securities that I sell to my investors are going to be mispriced, and I will be liable for that mispricing. If I use those securities to go and buy another company, so I issue a whole bunch of debt to go acquire a company, or I raise a lot of equity because I want to have a takeover, I want to build a new division. Anything that I'm selling that's inflated, I'm going to be liable for. And it's the same thing with firm operations. I can misreport or be devious in the way that the firm is operating as a way to inflate the value of the company. And we see the same thing with payouts as well. So the point is that all along this decision-making process, there's rampant opportunity for a lack of corporate control. So let's kind of provide some background. The public corporations that we're going to focus on are jointly owned by many shareholders that are all protected with limited liability. Limited liability means that as an investor in the company, my liability, the amount that I would be liable for if the company goes under or if the company something bad happens, if the company's sued, anything, my liability is going to be limited to the firm versus my personal wealth. So what that allows is for much more dispersed ownership, which creates an efficient way for us to share risk and to raise lots of capital. To understand why, if my liability is limited to the company and not my own personal wealth, then if I have a small amount of wealth, I can put it into many different companies. So it's going to facilitate this dispersed ownership. And we see this process in the real world when firms have initial public offerings, IPOs, the shares become listed on an exchange and then available for the whole public to buy and sell. So what is actually happening with this IPO? The entrepreneur, the people who start the business, they grow the business with other people's money. Yes, they're going to raise cash to grow the business. If you want to hire, if you want to invest, all of that takes money. So you sell shares to other investors or you borrow debt. That is, you raise funds by selling some of your ownership and control rights or giving up some of your cash flow rights to the debt holders. So as this happens, the ownership becomes dispersed. And what that means is that we'll have many, many owners who are often not the managers who are actually running the company. So the CEO, the managers, and employees all are going to work on behalf of the shareholders, the owners, and they, the CEO, managers, employees, have neither cash flow rights nor voting rights. Cash flow rights mean that you basically get paid out of the cash flows that are coming. You're entitled to those cash flows. Voting rights means that you have the right to determine who's on the board. You have the right to determine policy for the company. And those aren't rights that are allocated to CEO, managers, and employees. So how does all this work? Shareholders elect a board. The board then monitors and advises the firm. That means that the board's going to set policy, determine compensation, vote on major corporate decisions like firing the CEO, a takeover, restructuring, things like that. So what does all this mean? Well, if we can see from this diagram, notice that we have managers and employees reporting up to the CEO, and then the CEO reporting up to the board of directors. So the board of directors sets policy at a really, really high level, and then managers and employees are going to be implementing that policy, and the CEO is basically going to be guiding or executing the vision of the board or the vision of the CEO. Notice how on the other branch, we have cash flow rights and voting rights, and that's because, again, the managers and employees are not going to have cash flow rights and not going to have voting rights. So this split between owners and managers has some benefits that are direct to the firms and investors. And the first two we've kind of mentioned, but let's formalize them. First is diversification. So you can invest small portions of your wealth into many different firms. As diversification increases, the required return for investors and hence the firm's cost of capital is going to fall. And that should make intuitive sense. If I can put my money into a lot of different companies, then on average, I'm going to require a lower cost of capital because I'm diversifying my risk within my portfolio. So I'm able to get a better and better level of return for the same level of risk. And that's something that we'll work on empirically when we get into the second half of the course. You also have liquidity, meaning that you can easily buy and sell a stake in a publicly listed firm. So liquidity has many different meanings. Here in this context, we're referring to the fact that you can easily buy and sell a share of the company. And why that's important is because if the company has more liquid stock, then it's going to be less costly to raise equity. Think about it. Every time that you go to sell your stock to raise capital as a firm, you're basically going to be selling against yourself. So if there's no one else that is actually offering your stock in a SEO, and that's the case because it's only you can issue the stock, you're basically going to be buying against yourself or selling against yourself. So you really want liquidity. You really want the cost of raising equity to not be too costly. And all of this is going to increase your financial flexibility. There are also benefits that are more so economy wide. So those include more capital being available for investment. If many of us can invest in many different companies, we're going to save more and we're going to have more investment opportunities because, again, our ability to invest in the company is not limited by our own personal wealth. It's not that our personal wealth is up at stake, it's that our ownership of the company is up at stake. That also leads to higher market valuations. So if we have the separation of ownership combined with investor protection, as an investor, I'm going to be willing to pay an even higher price because I know that the cash flows that are promised to me are actually going to come to me. And all of this combines to have more efficiency within the capital market. So as we have more investors competing with new and different information, we have even better pricing, we have capital flowing to more productive areas of the economy, all of that leads to more growth. So this is fantastic. But in the real world, we also have real frictions. So for several reasons, us having diffuse ownership, meaning many small investors, can also lead to real problems for investors and real problems for the economy. And the way that we think about these problems, these frictions, is in this way. First, information is costly. So we have many, many shareholders. And because it's costly to monitor, they won't. To understand that, it's going to take time, money, and energy to gather new information and to monitor. Remember, we have this separation between the people that own the company and the people that manage the company. So think about it. You would probably not behave and monitor the company the same way if you invested $100 or if you invested 100 million. If you invested 100 million, you probably would pay more attention than if you invested 100. With the exception of GameStop, you would likely allocate your time and energy differently depending on your investment. And all of this is really a function of information being costly. And we have a free rider problem when we're talking about shareholders. So this free rider problem can be common in many settings where you have individual costs and a group benefit, almost like a group project. But with shareholders, the monitoring is costly and never ending. There's never a good time to stop doing due diligence. And also, all the shares have the same price. So why is that important? That means that if you do all of this work to monitor the firm and to make sure that managers are doing what they're supposed to be doing, and I don't do any of that work, the moment that you cause the share price to increase from your due diligence, I benefit even though I've done nothing because we're all going to have a stock that has the same price. So that creates a free rider problem. We have individual costs, we have a group benefit, it's very costly to monitor, and all of that can lead to shareholders basically not paying good enough attention to managers. So that's an information friction. We also have information that's often asymmetric, incomplete, and imperfect. So even if I'm willing to take the time, energy, and attention, all of that to monitor, the information that I receive won't be perfect. The information is often going to be asymmetric. So intuitively, managers are likely going to know more about the firm than shareholders. The information is often incomplete. It's going to be limited by what we can observe. So we'll be looking at signals. We'll try to use signals to infer the truth, but we only can use signals because we don't know everything. And the information is going to be imperfect. Even what is known may not be verifiable. That may sound obscure, but let's make it concrete. Sometimes it's really hard to observe and verify things that are important, like effort or satisfaction. I may know that my CEO works hard, but it might be very difficult to verify that my CEO works hard. I might know that the employees in the firm that I'm investing in are satisfied, but it might be difficult to verify that they're actually satisfied with their jobs. If they're satisfied, they're going to work harder, increase firm value. So the point is that first, it's costly to gather this information. Second, the information that we gather is often, it's not perfect. It's often asymmetric. Somebody else knows more than us. It's incomplete, it's limited, and it's imperfect. The last point is that we also have frictions in contracting. So in a perfect world, in theory, we can write contracts to address all of these conflicts of interest, all of these agency problems, but in reality, contracts are limited. It's very difficult to predict and contract every possible situation that the firm will encounter. So because of these frictions in information and contracting, this dispersed ownership is going to have some challenges that are going to have real effects on the firm. So because of this separation of ownership, we have the potential for these agency problems and conflicts of interest. Let's kind of make sure we understand what this agency and principal agent problem is. Okay, so the principal hires the agent to perform a service that the principal cannot perform themselves. So you hire an accountant to help you with your taxes and your bookkeeping. The agent performs the task, but it's hard to know if the agent did a good job. In our example, how would you know if your accountant did a bad job? There are many tasks that you can hire somebody to perform that you may not be able to perform yourself. Some of those tasks are going to involve performances that are easier for you to assess. So if you pay somebody to get you a haircut, you pay a barber, you pay a hairstylist, you get a haircut, it's really, really easy to see if they did a good job or a bad job. Okay, but there are other tasks that are a lot harder to verify. Let's stick with the accountant example. Your taxes and your bookkeeping can be incredibly complicated. It might be very difficult to know whether or not your accountant has done a good job or a bad job unless you get audited or you have some issue with the IRS. So the point is that we always are going to have this problem, whereas the agent, I need you to perform something on my behalf. I'm the principal, I hire you as the agent, I need you to do this thing, but I really don't know if you've done a good job or a bad job. It's kind of tough to assess. So the challenge is going to be to align the incentives of stakeholders who all have different interests. And they also may have competing interests. So we're going to have some large versus small shareholders. They'll produce twin agency problems that we'll talk about. The main intuition here is that large shareholders may have less diversification and therefore want less risk or more private benefits. Remember, we motivated this by saying that if I have diversification, I have a lower cost of capital because I basically spread my risk across many firms. But if I'm a larger shareholder, I'm going to be less diversified and I may not want the company to be so risky. Or I may have private benefits, i.e., personal needs and interests that I really want the company to cater to. So we'll discuss that later when we get into twin agency problems and when we get into ownership concentration. You also have competing interests between managers and shareholders, which we'll talk about next. Clearly, we're going to have competing interests between shareholders and debt holders. Our bondholders are going to want us to have safer cash flows that allow us to pay back the debt more securely. Our shareholders are going to want us to have riskier cash flows, appropriately risky cash flows that are going to increase firm value. And the way to think about that is, as a shareholder, I only get paid once the debt gets paid off. So if we're able to take risky and profitable business opportunities, I'm going to prefer that because if things work out, I get paid a lot more. And clearly, we're going to have many more conflicts of interest between managers, employees, suppliers and customers, governments and shareholders. There are all kinds of potential conflicts of interest that just happen throughout this process. So let's understand a bit more about this agency problem. So We understand that there's a principal, the shareholders that hire the managers, the agent to run the firm. Now, we started by saying that as a shareholder, I have cash flow rights and I have voting rights. That's different from what managers have. Managers are going to have discretion in what we call residual control rights. That means that everything that's not explicitly written out in contract that goes to shareholders and debt holders are basically going to be for managers to do. Managers are going to have to basically take possession of the firm's assets and then figure out how to actually fulfill the goals of the board. It's hard to know if the managers are acting on behalf of the shareholders. Managers want job security. So that can happen in a number of different ways. First, there's empire building. What that means is that you have wasteful pet projects or you engage in a lot of low NPV projects or negative NPV projects, all as a way to kind of keep yourself employed and to keep you necessary. So if the firm is doing things that are so complicated that you can't be let go of, you've basically given yourself job security. The other way that you can kind of pursue job security is by avoiding takeovers. Often, when there's a takeover, we're not going to have two sets of managers that are performing the same roles. So, some set of upper or lower level management is going to be let go of. So, if you are someone who's got the ability to determine whether or not the firm should pursue a takeover or be taken over, you'll probably avoid the market for corporate control as a way to stay employed. The other thing is just general risk aversion. So managers may avoid taking positive NPV projects that are too risky for their risk appetite, but could increase firm value. And the intuition is that, again, if the project is too risky for the manager might worry that if things go bad, they lose their job, so they kind of avoid it. So in these ways, we have a bit of an agency problem. And lastly, the thing that's probably most intuitive is outside of wanting job security and having risk aversion, avoiding takeovers, empire building, you may also just want a good life. You may want jets, nice residences, nice offices. You may want to live the good life. So we'll call these perks, perquisites, and we'll look at how they can also affect corporate governance a little bit later. So we're going to stop now. And for the second half of the lecture, we're going to get into different examples and then also talk about different solutions in dealing with these agency problems.